And welcome to all of our viewers, delegates who have joined us. Happy Monday. Hope everyone is well. Well, we're very happy to be back with just about the same speakers from our previous event, Net Zero and the Capital Markets in Asia Pacific. In that event, we discussed very much in general net zero pledges from countries and companies. We talked about some of the major issues you have to look at in evaluating them, and mainly talked in a general sense of how we can look at the credibility of these net zero strategies, how we can evaluate whether they are credible, actually helpful, actually materially important to reduce the effects and the scope of climate change. So in this follow-up event, what we're going to do is go a bit more into details. We're going to get a bit more technical, talking about some of the, I would say, potentially controversial issues, some of the technical questions, the debates that are actually happening among sustainability experts in looking at the actual details of these net zero pledges, net zero strategies, net zero pathways that we're seeing at various parts of the market. So very happy to introduce our panelists for today. We have Bernadette Victorio from Fair Finance Asia. We have Dardesha Morando from China Water Risk, and Anna Marie Slot from Ashurst, all very well versed in all of these issues. Just a bit of introduction from my side. By the way, I'm Mushtaq from ICMA. We have seen a lot of net zero pledges lately in Asia, and the number still continues to increase. For example, just as a reminder, the governments of China, Korea, and Japan have all made net zero pledges. Now, there are a number of corporates as well, such as Petronas in Malaysia, property companies in Singapore, supermarkets in Australia. Even PetroChina has said that it would be near zero by mid-century. And to reach net zero emissions by 2050, which seems to be the most common year for the pledge, annual clean energy investment worldwide, according to the IEA, will need to more than triple by 2030 to around $4 trillion US. But even on a macro level, there's still a long way to go before even the pledges are sufficient to reach global net zero. What I mean by that is even if all of the pledges are fulfilled, it may not necessarily get us to net zero. This is a very important point. And even the pledges that have been put forth so far, they are in many cases just that. They're just pledges or they're policy documents. They haven't actually been incorporated in law, much less implemented fully. Okay, so with that somewhat sobering introduction, we're going to get right into it. And we've talked about some of the overall big picture questions, but let's get into some of the deeper issues here. So the first question I have for the panelists is it possible to have a credible net zero strategy that includes fossil fuels? Will there actually be parts of the economy that realistically still need fossil fuels? For example, you hear that aviation will be difficult to have planes without actual carbon fuel. So I'll start out with perhaps Anna Marie, you can kick us off here.
Well, thanks, Mushtaq.
Sure.
Look, I think, particularly for Asia, that's a live and valid question because, as everyone realizes, people are at different places in their in where they are, and there's also quite a big conversation that goes on in the background, kind of about, equitable treatment across countries, right? What country did what when, and what's responsible, who's responsible for what. And so I think there's a large group of people who think that at least in the short term, fossil fuels are necessary while technologies develop and while various things are evolving. Because as you said, the IEA, their roadmap recognizes an enormous amount of investment that has to go into solar and other renewables in order to get enough energy for people to connect to the grid or to be ideally self-fulfilling. I mean, the dream of everybody having enough solar to provide enough energy for themselves is one dream that people have, but there are enormous numbers of people, especially in the Asian region, who don't have access to the electricity that they need. And so there is going to have to be, I think, at least in the short term, some realization of that. Do you I mean, is that countermanded by other people moving faster? Maybe it is, actually. Maybe you have a different scope of what different people connect to and commit to based on where they are. Like, do the Nordics commit to one level? Does Europe commit to another level? And that is, I mean, because we're talking about one planet, right? So the whole equation has to balance across the entire planet. That's probably my opening. I don't know, Bernadette and Risha, if you wanted to input.
I think the ambition of all these net zero targets are very important, and I'm glad that they're also coming through. But now is the very difficult part of figuring out how do we actually get there, because I feel like quite a few of these targets have been put in place without that planning actually going on. It's, well, nobody actually knows, so we might as well say we're going to do it, and then we can set the targets and plan how we get there. So I think that's good. I think the ambition is there, and I think that saying it out loud means that you are being monitored in a way, and people are looking at what you're doing. But just there's a lot of talk about, technologies that we don't have yet will save us, and I think that is, we will need some of those technologies, but just relying and hoping on those is a bit dangerous. So we need a plan for all of this. But I'm a water person, so I'm going to answer this from a slightly water angle, which is when we look at all these different power options that we're going to be thinking of, we have to think about how much water all of this needs as well, where they're located, what are the physical risks. Let's take nuclear. You mentioned nuclear. It is important potentially for baseload, but again, it needs to be in a water abundant location. So whether it's by the coast or on a river that has plenty of water, has that been put into the forward planning of, is this plant going to be resilient in the long term, depending on whether the river is going to have enough water, whether there's going to be coastal threats because of typhoons or storm surges, etc., which unfortunately are only going to get worse. So has all of that planning been put in place as well? And then maybe it all makes sense. But I think you need to look at it from the holistic big picture of, this is the path that we are currently set on, which there are lots of physical risks we need to take into account. And has that been included in the planning?
Yeah, go ahead, Bernadette, and then I'll respond.
Sure. No, I was just going to say that, and it's been referred to a couple of times by Mushtaq and also Anne-Marie, that since we had the first discussion on the net zero targets, International Energy Agency came up in the meantime with a report that details, the potential pathways towards going net zero, globally by 2050. And as pointed out by Risha, obviously there are many other considerations that need to be taken into account, and also the pace by which every country, every region in the world has to do it, as Anne-Marie also referred to, is important. But overall, I think what we all feel from the civil society world is, for example, this is a welcome report, that it's actually, very clearly set out in that study. What are the milestones we should look for example, in assessing net zero targets, if we are going to follow that transitional pathways recommended by their report, then there becomes a very clear, timeline by which we can say unabated coal should be, completely banned by 2040, which means we should consider 2020, the decade of really pushing for renewable technologies. And while a lot of those technologies are still in, in trial phase, in testing phase, but also more expensive, more and more we are also seeing that a lot of them are becoming affordable, like solar panels. And so we really want to see that not only the technologies are moving in this decade, but also regulation, creating, more incentivization for that transition to move faster and also all financial sector actors to be looking at that pathway and having a same idea or transition milestones in mind, and then the commitments can be provided with more clear bound targets, with clearer strategies how every sector could be adjusted to align with these targets.
Okay, thank you, Bernadette. A lot of interesting points raised here, and I'll just summarize a couple of them. By the way, thanks to those of you who have asked questions. We will do our best to get to those. I think they're good questions so far. So please feel free to enter your questions in the Q&A during the course of this discussion, and we'll try to manage that so we can answer those. Well, a couple of the points that I think are very important here. One is the pace of decarbonization. I think as a sort of an amateur mathematician, I mean, it's one thing to say that you'll stop carbon fuels by 2050 or stop using carbon-based fuels by 2050. But in terms of actual climate change, what really matters is the path to how you get there. If it's all suddenly in the past, in the last 3 years before that you're reducing your use of carbon, then that's obviously going to have a much different effect on the environment than if you stop using carbon now and then have a much easier way to get to 2050. And I'd like to actually hear the panelists' views on that. But before I do, just a couple of other points that I think are really important to mention. One is the sort of overall environmental effects. You mentioned water duration in particular. Forestry, for example. So even decarbonization using nuclear, for example, as an alternative fuel can have potential risks and have potential other effects on the environment. Some of which have to do with climate change, some of which may not even have to do with climate change, but are still absolutely important. And then Anna Marie mentioned social issues as well, which is a question that I hope we have a bit of time to get into, because I think that's extremely important, especially in Asia. Decarbonization obviously has structural effects on the economy, and that's going to have major implications for social policy and the politics involved. So actually, let me just throw out a question in terms of the kind of ambition and the pathways. Do you see these the net carbon strategies from corporates and from countries? Do you see them actually ambitious enough in terms of their pathways? And do you see them kind of sophisticated enough in looking at these additional risks, just in general, and particularly in Asia? And I think we may have lost Anna Marie, but we'll get her back.
Okay, I will unmute myself. So from Asia, I think some of the countries could be more ambitious. I think for me, I would like to see developed countries in Asia, in Europe, in the US, etc., actually being more ambitious. Because saying 2050 net zero, I don't think is good enough. They should be saying net zero much earlier on. Yes, this is all going to be quite difficult, but I think it's setting that ambition from the get-go that this is what we plan to do versus waiting. Because again, like you said, it all depends on the path, right? Because if you're going like this and then you slow down, right at the end, it's not quite the same at all.
Yeah, I think from our perspective, definitely from the civil society perspective, it's not ambitious enough. And there is potentially a reason there that the strategic approaches being used to determine the pace at which these companies or countries will move towards net zero transition is using still the scenarios of the past. Whereas we should be looking really more of the forward-looking scenarios and looking more at the forward-looking trajectories rather than using the technology, the assessments of the past, risk assessment of the past to determine.
So what do you mean by that? By using the assessments of the past as opposed to the assessment? Do you mean they're using kind of past policies, or they're using kind of climate models from the past? What is that?
Yes, exactly. So a combination of that, but also assessing, going back same to the assessment of the bottom lines. What would they look like, in the past experience of still being invested here, and what type of profit will still be gained by not decarbonizing or going net zero faster. So rather, I think now when we have now that we are having more and more these type of reports that show clearly, an overarching framework for everyone to sort of use as a benchmark. And again, I'm not saying that this is the best, but this is so far one of the ones we have so far, and that becomes, if that becomes a roadmap for everyone, a blueprint by which we could all potentially adjust our targets and commitments towards, then the risk assessment or the impact assessment becomes different, because then you're forward looking, you're assessing what would be that kind of profit or loss of profit in the coming 10 years or 20 years, which is near term planning. And that is what's lacking at the moment. And that's potentially also what we think, would be important to see now that there's a better idea of how fast we should be decarbonizing against these commitments.
Okay, I'm going to go to the Q&A a bit. We've got a lot of great questions so far. And actually one really basic question, which I think is an excellent one. And then another question, which is a bit more technical. So first of all, the very basic question, is carbon neutral exactly the same as net zero? We hear both of these. And then I'll add another question to answer right now, which is, what are the actual tools that companies, banks can use right now to understand what their transition pathway should actually be, or how to define a transition pathway? The questioner raises a good point, is that I think there's a lot of technical advice out there, but if you're kind of the average banker or the average person in a corporation, you feel a bit lost. I mean, what exactly does it mean to go to net zero? How do you kind of find an actual way there based on your sector or your activity? So two-part question, leave it open to everyone to answer. Anne-Marie, I'll volunteer you.
No, so I mean, this is one of the interesting things, right? Is that there is no definition of net zero, right? So this is a problem, or not the problem, but really the challenge of kind of looking at things apples to apples and comparing them. And I don't know if there's anybody old enough on the phone to go back, but if you go back to sort of looking at different accounting standards, right? If you looked at US GAAP against IFRS, and before that you had every country with their own GAAP, everything looked on the slightly kind of close, but if you actually drilled down into it, as bankers who are building those models, you realize that those numbers were not the same, right? And so that's the point we're at right now. And the markets have gone through this before in other places, right? And so this is something markets know how to do, kind of suss that out, but it usually takes a bit of time. And so given that there's no universal of net zero, you can have net zero GHG, meaning you're going to take out all of the human generated GHG acid that you're producing. You are becoming more efficient and therefore no longer producing them, or you have created something that tracks them back out of the environment, right? So where you see these great stories about how seagrass grown on the on the floors of the ocean are more extractive than forests now, and so that there's that extraction, and then there's also human designed extraction, which is what people are talking about with these sequestration CCUS with carbon devices, not devices, but basically kind of construct where you are capturing the carbon and putting it somewhere back underground or somewhere. And so that net zero GHG, but there's also other net zero. There's lots of other, right? People go net zero carbon. They go net zero CO2, right? There's lots of net zero. And then that doesn't even, and some people, when they're talking about net zero, they're talking about the impact that they feel that should have. Like, am I essentially having less impact on the earth than am I leaving it in the state that it should be left in, or am I taking something from it? And that can be, to Lisa's point, the water, its biodiversity, its social impact. I mean, there's lots of different impacts we have. So those two terms are not alike. Carbon neutral. Carbon neutral is, I'm at a net zero. And then you get into other layers of the conversation, which is that there are lots of voluntary bodies that are making structures and frameworks. And so when you're talking about what you're saying, you have these voluntary bodies that you can go by. So like science-based target, that is something that has a framework to it. So when people talk about that, they have to conform to that framework. And so that's where we're at in the conversation. And I think that's why it's a really interesting conversation, because if you go to Bernadette's point, is you're looking as a banker, as a lawyer, as anybody else in the market or company trying to deal with, you're trying to assess a whole new set of information in a completely different way, because you can't look backwards. You're trying to look forward. And you're trying to look forwards with a different set of terms than you used before. And you also kind of have to look at it in a way that the historical norm is not going to be future current, right? which is the key for companies when they're thinking about it, because all planning, all budgeting, everything that people assume the underlying input is the same. And that's kind of the fundamental thing. The underlying input's not the same. It's not going to be the same unless we fit what we're doing. Because if we don't, then the number of extreme weather events is going to increase. The cost of electricity is going to increase because it's going to get hotter, and so you're going to have more air conditioning, right? If you even have air conditioning, or you're going to have to deal with extremeness of some type, which isn't in the budget process. Now, that's a lot. Sorry, I kind of went on there for a while, but there's a lot. There's the problem. There's a lot in there that doesn't fit the soundbite.
Yeah, I think you've identified the go ahead, Darsha. I actually, if you don't mind, I'll just because I did happen to look this up on the web, and the UN Intergovernmental Panel on Climate Change, which is, I would say, one of the more authoritative bodies dealing with climate change, actually does have a definition of net zero, and I'll leave it to all of you to evaluate the efficacy of that definition. They define net zero as, quote, being achieved by cutting emissions to as close to zero as possible over a specified period, and compensating for any remaining emissions with projects that remove emissions from the atmosphere. So an interesting way to look at it. Yep. One thing that's interesting to me is that it doesn't say zero. It says as close to zero as possible, which doesn't seem to me it's being exactly the same as zero. And also in terms of compensation, it's looking at removing projects that remove emissions from the atmosphere, which is distinct from some of the carbon offsets that we're seeing in the market, and which we will delve into in a little bit. So sorry, Darsha, please go ahead.
I know. I was just going to say very simply, it is what the IPCC defined it as, which is how can you reduce the emissions in your day-to-day activities. If you're a bank, that means if I'm lending to different clients, I need to reduce the lending I'm giving to fossil fuels companies or any companies that are quite carbon intensive, and potentially also increase my lending to renewable energy, to any kind of company that is sucking it out, basically. So helping with this whole carbon transition. I think sometimes the net zero, carbon neutral conversation complicates it, but that very simply it is, how do I reduce the emissions? And for a bank, it is not from how carbon intensive I am or am not in my building, because that is a very small part of what you do. It is all about your loan book and what you're doing there and all your clients there, etc. And that, I think, is quite important. So I think we need to not complicate it too much, because then we can start arguing about the definitions and is this it, this is not. Instead, it's just reduce and invest in those that will also help reduce.
Thank you. And you've raised another very important point, which is talking about the bank's activities in financing carbon emissions. I would add that there are others in the market who have looked at not just loan books, not just the investment, the kind of asset side, but also activities facilitating financing for banks as well. And this is something I think Fair Finance Asia has looked at quite carefully. So before I get to some more of the delegate questions, I do want to talk about this this issue, or not issue, but this topic of carbon offsets. So this is something that can be quite confusing. We're hearing a lot about carbon offsets being used by companies, being used by funds, potentially being used by an entire market to help achieve net zero. And what I'd like to hear from the panelists is, first of all, maybe a carbon offset 101. What exactly does that mean? Maybe in a simpler way. If there is some complexity, that's fine too. And then secondly, how should it kind of not be defined? Where are some of the red flags when we hear announcements of carbon offsets in the market? And then maybe one more follow-up question to that is, what is the potential of carbon markets, and how is that related to these potential carbon offsets? So three-part question, but please go ahead. Anyone want to start? Anna Marie, go ahead.
Again. You can start with me.
You have that look. You're smiling.
So look, carbon offsets are now, everyone's talking about them in the news. So what at its most basic is, are you offsetting some kind of carbon that you are emitting in some other way, right? And I think the key really is that for all of this to work, there needs to be a huge focus on efficiency so that you are actually emitting less, right? So that's a key component for everyone to do, and I think is something that markets are used to doing. How do you get better and more efficient each day, right? So, but there's a recognition that there is emissions that are still going on that you will also need to be offsetting. And the key question there is, are you doing some project that is verifiable, that is that is actually having an impact, right? And that is having the impact that you want it to have. So are you doing something that is extracting CO2 from the environment usually? So things like building forests is something that people think of. Okay, so let's build a forest, it extracts CO2, trees are great at that, right? But the questions around that are, in what time frame are they extracting? For how long are they extracting? Is it a baby forest not really extracting yet? Right, so you're emitting today, but you're extracting in 10 years from now at that level, right? So at what level? I kind of like to think of it as like, it's going to be sad, just maintaining your weight, right? So to Dorisha's point and to your point earlier about like what's your scaling, like at what rates are you doing things? If you do nothing now and you just eat a lot of pandan cake and just hang out, it's going to be harder in the end to get back to where your body is functioning well, right? Whereas if you just ate less all the way along, it's probably a little easier to stay within that kind of range. And so, the process is, companies can't just sit and say, I'm going to buy a whole bunch of offsets now, and then I'm going to wait for technology to come along that doesn't exist yet, that's going to solve the whole issue. Everybody. And I think that's why the IEA plan is really interesting and helpful, is it gives people roadmaps along the way. What do I have to be doing now? What can I be doing now? What should I be focusing on now to make that path more achievable and more likely to occur, even with or without technology coming along, right? And so the offsetting is all a part of that. And what people are afraid of is that people will say, oh, well, I can just offset everything, and therefore I don't have to change my behavior pattern. And that is clearly not going to be possible, right? There's no way that the number of people that live on the earth are going to be able to continue to live, in the manner that kind of upper middle class of industrialized countries live, and not have to adjust behavior.
But sorry, and maybe this is a question for all the panelists, but you mentioned offsets such as you can pay for trees to be planted right in a forest. That obviously sucks carbon out of the atmosphere. We can debate whether that's legitimate or what the quantum is of that. But I've also heard in the market, if I'm not mistaken, some entities say invest in renewable energy or invest in very low carbon technologies, for example, and count that as an offset. Is that legitimate? Is that accepted? Maybe I'd like to get everyone's opinion on that. Or are there other types of kind of investments in carbon offsets besides, forest trees that are potentially very promising?
But I think that's one of the good thing about, again, the IEA studies, that it doesn't base itself on offsets, right? Because if we base too much on offset, it becomes a loophole that you can continue polluting with your one hand and try to save the earth on the other. It couldn't work that way. I think the focus really should be on ensuring that we stop emissions in the way that our organizations, companies, or financial institutions are able to do that. And for the financial sector, that comes in the form of lending to project finance, specifically in high-risk sectors that are continuously using technologies that are harmful for environment, and rather divesting or diverting that financing towards, financing more renewable technologies, scaling them up, making them more affordable, especially for communities and countries that require, the transition. And I think for countries and governments that have, the capacity to do this, we hear now that the G7, for example, has pledged to increase their climate finance. What does that mean? Where is that money going to, and how is it going to actually impact, the scale up of technologies, the transition of communities? How is it going to support developing countries from developing strategies in developing actual strategies to comply with, the net zero targets or pathways, transition pathways that we are seeing, even as recommended by the IEA. So many organizations or financial institutions will say, well, every one of us has different portfolios, different activities, and that's exactly where we have to look back and see how much of that activity affects the actual emissions rather than offsetting with planting trees. Or because then, without going into the complex details, then we have to argue about the accounting details of that. Is there one, acceptable accounting to say that this is offsetted? Is that in line with the net zero targets, really cutting the emission or balancing the amount of carbon dioxide in the air because you've planted X numbers of trees? So that becomes more complex rather than just going to, stop the emissions.
Right.
Yeah, I have to agree. I mean, I think carbon offsets are being used as a transition tool, maybe, but also, as Bernadette said, maybe on one hand to keep polluting and then buy some offsets and say, okay, look, I'm absolutely fine. Look how green and great I am, but you're not solving anything. And also, obviously, what's going to happen because we don't have enough planets for all the offsets that we need. How many trees can we plant? We definitely don't have enough. We don't have enough space for all of this. So I don't think offsets can be a solution for very long. It's a bit of a stopgap until you can transition into a much lower carbon operational model. But until then, I don't think this can go on forever though, because we're going to run out very soon.
Okay. All right. Well, let me shift focus a little bit. We have a number of questions about the finance sector, what the finance sector can do, and in particular what the capital markets can do. So maybe I'll just start with Bernadette again, and thinking about this a bit more holistically from the financial sector perspective. What more should the finance industry be doing? We'll get into a bit more detail about the capital markets and what can be done in terms of green, social, sustainable bonds. But how do you look at the financial sector as a whole in terms of its strategy and what it needs to do to facilitate net zero? Looking at it from a kind of a big picture level.
Mm-hmm. I think from the big picture level, obviously, we see a very important role for regulation to do this. Voluntary commitments are very important, and we know that a lot of companies and financial institutions are really trying to, create very science-based targets. But the implementation will boil down to how well these commitments are translated into actual implementable policies. And the policymakers, the financial regulation has a very important role to do that. And in order for financial sector to be able to track the progress, to see whether we are meeting the targets, they have to really lay down from the whole process, creating a taxonomy that addresses what is good, what is completely unacceptable activity. And by then, that gives already the financial institutions a very clear guidance on how they would define or look at their portfolio in a way that they could define how they could transition them in accordance to the pathways that are recommended. There should be incentivization for financial institutions to move faster towards transition and really cutting emissions, scope 3 emissions, through their financial activities, through their underwriting services, their lending to high risk sectors. And the financial sector also has a very important role to ensure that these are very much integrated into national transition pathways that do not only include the financial sector, but other sectors or agencies that support national transition. And they are able to do that at the national level, but also coordinate more internationally with other countries and their neighbors.
Thanks. And I can say, yeah, go ahead, please.
Sorry, I just wanted to add that I think for a financial institution, I think they should be forced to actually assess what the risk could be. Currently, they're focused very much on what could the carbon risk be if we get to 1.5 to 2 degrees. But if you also look at what could the physical risk be to my mortgage book if I get to 3 to 4 degrees, I think that is a very powerful incentive of, okay, this is very expensive. I have to decarbonize so that we get to 1.5 to 2 degrees because my mortgage book is a huge part of my loan book. And I will lose all of that potentially if we keep going the way we're going. And that, I think, is a powerful incentive. But right now, the assessments are very much focused on the carbon transition risk, which is, and then transitioning for the sake of transitioning, which isn't good enough. No one's going to do a good job of it because it just doesn't make sense. The carbon prices aren't expensive enough, et cetera, et cetera. So the only way I think banks and financial institutions will start doing this a lot more seriously, and not just banks, but also corporates, is if you look at what the physical risk could be if we keep going the way that we're going right now. And okay, so we have to avoid that, and what do we have to do? Otherwise, I think it's a hard thing to persuade a banker to do. Reduce lending to investors that you're making a lot of money from.
It is. I mean, banks have shareholders, banks have CEOs, banks have people who are paid to make more money. And I think it's a fantastic point, an extremely essential one here, because I think that, I mean, what I'm seeing in the market is there's really an increase in sophistication. First of all, I think that many of the kind of vanguards, not just the sustainability cheerleaders, but actual very sophisticated investors and risk managers are starting to understand very well that there are monetary risks and that there are kind of quote unquote financial sustainability risks associated with climate change, particularly in the long term. And I do think that a number of academics and a number of the banks themselves are starting to get their heads around this. But I would have to say, and I could be wrong about this, correct me if I'm wrong, but I feel that it's not really become common practice, except at most of the very sophisticated asset managers and some asset owners and banks. Certainly not in Asia among the kind of vast population. And my impression is that a lot of these very long-term risks are still not necessarily being priced in. To the extent they can actually be calculated. It's actually quite difficult to do that.
Yeah, and I agree, and I think there's a lot that needs to go into it. But for example, the ECB just published some work that they've done on stress testing all European banks. So they've looked at 2,000 European banks and 4 million assets, I think. But obviously, so they've looked at it from a carbon perspective, but also on physical risks, and the physical risk is based on a lot of these European companies, so headquartered in Europe. and they've looked at mainly the headquarters and not all of the assets, etc., which might actually be in Asia. And the conclusion is, yes, the carbon transition risk is big, but we need to do more. More of a worry is actually these physical risks that we aren't doing enough to assess. And how do we, we are figuring this out, yes, but we need to start figuring it out and start pricing it in, but also using plausible tail risks. Instead of looking at the best case scenarios of, oh, okay, this could happen, but actually, what are the tail risks and how are you placed against all these risks that could actually be happening much sooner than many realize, because they aren't actually delving into the science, which now says that we could be looking at 3 meters of sea level rise in the next 70, 80 years, whereas before we weren't really looking at those kinds of numbers. So they keeps changing.
And I think also, look, I think I'd say a couple of different things. I think reporting structures like TCFD are helpful for that, right? Because if a company is choosing to report on TCFD, they actually do have to sit down and do scenario testing. So not just the bank, but the company itself has to look into the future and say, okay, what are my material risks? And if they were to go wrong, what would that look like, right? And I think events like COVID actually perversely are really helpful, because at a board level and a senior management level, maybe something like a scenario where everybody had to go remote overnight and you had to shut down all travel was something that you spent like a minute and a half on in a board meeting and say you had moved on and you tested that scenario. But now it's happened, and people realize that things that they didn't think had very high likelihood of happening have happened. And so climate change falls into that kind of impact and restoration. It falls into that category of something that people probably thought in the back of their mind, maybe something. But so I think the TCFD type structure where you have a forward looking is really helpful. I think actually in Asia, it's really helpful that a lot of companies continue to be founder led and founder controlled, because founders have a lot longer timeline than a PE house, frankly, right? Who's in and out in 7 years or 5 years or whatever their stated return is. And so I think to the extent that continues, those are groups of people who are very focused at thinking, okay, well, I have a 10, 15, 20, 30 multi-generational time frame. You look at some of the in home that are family run generation. Those guys, they don't look in a 3-year window. They look, in a 50-year window. And that is hugely helpful, because when you sit down and you plan that way, then you can get to this. And then you realize the three, the quantum of what Darisha is talking about is massive, right? That kind of sea level change, I think it's something like 70% of the world's cities are sitting on waterways or next to waterways. That is a massive impact on real estate globally, right? If you have those kind of levels. And so I think those two things are really helpful. And I think, to Bernadette's point on regulation, look, I'm an American. I am free market to my core. And so I love when markets actually solve problems. But I think there is a role for setting some baselines. And I think if the industries don't get out there and set their own baselines, then the regulators are going to be following up pretty soon to do it. And so I think organizations like, Climate 100 that are bringing together businesses to figure out what this is, and I think to the extent that governments can take out the externalities that are in the market, because, I'm also a realist. There are a lot of incentive structures in markets that are not pure. They drive a certain outcome. So to the extent you can extract some of those that were driving the wrong outcome and put in place something else, I think that is a key driver for how you get there in the short, and the medium, and the long term, really.
That's great. And so I work at ICMA. We're a trade association. I like my job, and I think we do good work. I hope you all agree. But I do think that there is a role to play for both the private sector. You're laughing. For both the private sector and the government. I happen to believe in free markets myself, but free markets cannot do everything, right? And we've seen, particularly in Asia, that government, you can call it regulation, or you can call it support, or you can call it encouragement, you can call it something in between, but it's been really essential for building up the sustainable finance market in Asia. And I think having that kind of leadership from the official sector has been extremely important. I do also happen to agree personally, maybe not ICMA's view, but personally with your view that the market is not always able on its own to price in all the externalities in an appropriate way. And sometimes the structures that are set up at the official level can actually encourage the use of fossil fuels. We definitely see that in Asia, right? So in some sense, you may need official sector action to remove some of those structural barriers to these net zero pathways. One more point I'll make before we get into a little bit about capital markets is just an observation from our members in the industry. And I think the good news is that we're seeing huge amount of awareness internally in these organizations, banks especially, for sustainability issues. So whereas 5 years ago you didn't really care about sustainability and what you're doing, now it seems that at some of the banks, at least that I'm aware of, all major loans, all new clients will have to go through all the different hoops that you go through with KYC and so forth, of which sustainability will be one now. So every big investment will now be evaluated through a sustainability lens. But what it seems to me that when they're talking about sustainability, it's from, first of all, maybe an ethical angle, right? Do we want to be kind of perceived as being pro net zero against climate change, and also from a reputational risk, so PR risk, right? Is this going to make us look bad if we invest in this company? And I think what Darsha and Anna Marie are kind of getting at quite well is that if the conversation is shifted to actual physical risk or asset price risk, then it becomes a much more powerful argument, I think, internally for these banks. Okay, again, we'll shift gears a little bit. There are a few questions I really want to get to, but I think a number of the audience members have asked about capital markets and whether it's appropriate for the markets to make the rules, the punishments associated with green bonds and sustainable bonds kind of more rigid. Whether it's a good idea to make these kind of more strict. And I have views on this from ICMA. I have a bit of experience, but maybe if any panelists want to weigh on this, are green bonds as they're currently used simply not strict enough? Do there need to be kind of more stringent punishments on these to make sure they're more credible?
You can come to me first again. I might as well just jump in there.
Okay, or I can go first. It's fine.
If you want to go first, I guess my big point is what people are all over the camp on this one. I think that the key is to not let perfect be the enemy of good, right? And to my mind, everyone needs to be doing this transition. And if there are people that are taking advantage of it, the market will sort them out. Investors are smart, and investors won't be fooled twice. Is my theory. Sometimes 15 years passes and a whole new group of investors that don't remember what happened 15 years before. But maybe Mushtaq, you want to jump in?
Yeah, I'll make a couple of points on this. I mean, this is an area where I do have some experience. So first of all, I would say that if you look at the history of green bonds, actually, right now, if you say, let's say you issue a green bond, your proceeds don't turn out to be green, what happens? There's actually nothing in the legal documentation. There's no default. There's no penalty. In sustainability-linked bonds, perhaps that's a little bit different, where you've got a sustainability KPI, and if you don't meet it, then there can be economic consequences to the bond. But let's just talk about kind of our old friends, the green bonds. Legally speaking, there's no real punishment. There could be some prospectus implications, some prospectus disclosure implications, but again, that's a bit on the side. And why is that? That seems quite odd to people who realize that for the first time. Well, the reason is just market reality, because I'm a former DCM practitioner. Anna Marie knows this as well. An issuer that's contemplating issuing green bonds will simply not accept extra legal risk that may result in a default of their bonds. And the way that many issuers are set up, especially large ones, is that if there's a default on one bond, it's a cross default on their whole liability portfolio, which is an enormous disaster, frankly. And most issuers, or all issuers, frankly, who are issuing green bonds, simply do not want to take that risk, especially if it happened for reasons outside of their control, through an M&A or through, through a natural disaster or something like that. So this was just basically a kind of agreement, ladies and gentlemen's agreement between investors and green bond issuers that the issuer would be trusted to keep with their promises under the green bonds. And so what happens? In fact, there is a ramification if the issuers don't abide by what they said they would. They get shamed in the market. There's a huge reputational risk. And for an issuer in the current market to go to the green bond market, to put themselves out there as being green, and to do actually a lot of work internally to revamp their internal processes, to get all of their internal stakeholders aligned with a green bond issuance, to put together the disclosure and the various processes that are required for a green bond issuance, to do all of that, and then to fail to actually issue a credible green bond is something they really don't want. And the market is extremely sensitive. Investors are extremely sensitive to issuers trying to be a little bit cute or to kind of get around. And generally, banks will not want to serve an issuer who wants to do that. And generally, external reviewers will be very careful about putting their own reputations on the line. So fortunately, although it's not a bad suggestion to make the green bonds more strict in the legal sense, there are a lot of, I would say, checks and balances currently in the market. But overall, I think another kind of thing that's starting to change is that up until now, sustainability and the sustainable bond market was very much a voluntary market. If you want to issue these bonds, then you go ahead. And what we're seeing now is that sustainability is no longer a voluntary thing, right? With regulation coming in, with the disclosure requirements coming in, basically every entity, every bank, every corporate has to be sustainable. So we may see in the not so distant future a world where green bonds and social bonds are not something that you kind of decide to do on the side because you want to be more green. Basically, every bond will be evaluated for its greenness or its sustainability.
And maybe just to add to that, because you referred to the legality, I mean, we've all seen what happened in the Netherlands, The Hague, with the historic ruling of the Shell, to cut their emission. And we see that this isn't only happening in the Netherlands, this has happened in other countries, in Germany. And so if financial regulators are acting, the court is also stepping in to put these legal rulings there. So we see that many actors, agencies in the society are actually trying to take, to make companies like Shell and obviously their financial investors accountable for their activities. And so what will be the implication if you refer to the reputational risks of the investments that are going into these types of companies that are ruled really not following the environmental frameworks that are being issued. So we are very proud of this because our colleagues at Milieu Defensivo is actually working very close to this, and we are very happy for their success, and we really look forward to more of these kinds of actions happening around the world. And we hope that financial investors and also big companies the same as Shell will take this as a signal also that there is more awareness and definitely more actions that are happening in this area.
Yes, thank you.
And you see that also in the Australian ruling, right, where the courts determined that the government had a duty of care towards younger generations and the speed at which you are on a transition pathway, which is similar to the German one, that you can't put all the costs out in 2050 and get all the benefit in 2030, which is an interesting new nuance to the kind of just transition, right? Because just transition in the context of sustainability has always been talked about from a country perspective, right? Where's the just transition? Who's bearing the cost? But now it's also being looked at an intergenerational perspective by the court. So I mean, Mushtaq makes a really good point, Virgin. What do you think? If you watch what's happening in the courts, and I think also if you watch what the stock exchanges will be doing over the next couple of years, the rigor that people are asking for in the markets will be driven from the disclosure requirements that are coming out of different areas there.
And another point to add on this is that we're talking very much about what I as a company am doing to impact the environment, but I think a lot of these bonds aren't actually looking, or disclosure standards, etc., aren't looking at what the environment is doing to impact you as a company, whether it's within the bond, whether I'm investing in renewable energy projects, etc. Is that being looked at as well? Because that's a huge risk. And if that isn't being assessed, then that could potentially be a big problem in the future. And then another product that we should have, and more of these, is adaptation bonds. We don't have enough, and we need more of these because we have to protect, 3 meters, right? If we have 3 meters, we need to protect so many different coastlines and cities and areas. Or do we actually have to rethink how we develop and change and, big picture, etc., which is a lot scarier actually. But from a purely financial product perspective, we should be looking at how do we look at adaptation bonds as well. There will have to be a lot of government investment in this, but that will obviously drive private investment as well. And what can financial institutions do to play a big part in helping drive that? Because I don't think there's enough. At the moment, when we look at green finance, I think it's only 8% that goes towards adaptation. That needs to grow. The entire pot needs to grow, but that percentage has to grow as well.
Okay, great. We're almost out of time, but one final question I really want to get to. And we talked about these court cases, which are super interesting, basically based on human rights argument, right? That companies, that the countries have a duty of care towards their citizens. But even with these decarbonization strategies, there are social costs. And that could be taken into account as well with this duty of care, with human rights issues. How do you address that? How do you address the potential unemployment effects? The potential people having to move. Different aspects of development. If you can answer that in 30 seconds, it would be great.
Okay, I'll go first. Sure. I think we need a very much a holistic approach to all of this. We have to look at the big picture. We cannot just put stickers on everything, which it feels like we're doing at the moment. We have to look back and think, okay, how do we get to the place that we want to get to? And that, I think, has a huge role for policy. And then the second part is how do you manage that? And that is very much drawing in the private sector, whether it's finance companies, etc. And then the third part is how does technology help us with all of this? And yes, there will be social issues with all of these different transitions, but I think we need a bigger picture plan on how we get to that. And thinking long term is very, very important with all of it. That's my answer.
I can go next. And I think this is more on looking really at the impact rather than risk assessment, move towards impact assessment. And national governments, together with the global financial sector, need to take into account that the transition really has to take along the communities. You mentioned already the massive job losses. So there has to be massive reskilling of communities, to work in with different technologies and gain new jobs in the new technologies. We always hear that the green movement will also bring green jobs, and that requires, proper reskilling, proper consumer empowerment, consumer education as well. And that massive level needs to be taken into account by the governments. And obviously, when we are thinking about increasing climate finance, that definitely has to be taken into account, not just giving the money, but also taking communities along, providing capacity building, providing the necessary market support so that the job losses that can be also taking into account, not just at the country level, but the migration and the cross-border effects of these job losses. What does it mean for one country? that relies heavily on migration to operate these technologies. What does it mean, for countries that are sending and receiving those labor forces? So those have to be taken into account, and the consumers need to be very well educated, to be provided the right toolkits to understand what their choices also at the individual level are, how these are contributing also in terms of changing the overall transition towards sustainability in Asia and the region. It's easier said than done, and obviously we have to take into account more complex political, social, and discussions there, but it's a start. It's a place to consider and a place to start.
Thank you. I think we're out of time, Anna Marie. I'm very sorry, but
all right.
we'll leave it for next time. Thank you all very much. Sorry we didn't get to all of your questions. I think we have another 2 hours worth of discussion topics, but thank you very much to all of the panelists for coming back. A very interesting discussion and a really important one, I think.